Hello, my awesome accounting students. Today's topic is payroll. This is a chapter that definitely most of us can relate to. If you've ever received a paycheck and wondered what were all those things that your employer took out, then this is the chapter for you. Having said that, the best way to understand this chapter is to go back and recompute every payroll tax that you see on your payroll stub. Let's get started. One of the first things that your chapter discusses is the difference between an employee and an independent contractor. This is a hot topic at the IRS right now. So take a moment to review the characteristics of an employee. Usually the employee works under the control and direction of the employer. They typically use tools or equipment provided by the employer. They work certain hours that are set by the employer, and the employer determines how the employee completes the job. You can think of multiple examples of employees. Sometimes the line becomes blurry. Why is this important? Because employees have their taxes withheld from the employer and passed along to the federal and state government, but independent contractors have to pay their own employee taxes. There are several laws which are specifically important to payroll. One of these laws was called the Fair Labor Standards Act, and it defined what proper working conditions were and the maximum hours that employers could have their employees work for them without having to pay overtime premiums. In addition, the Social Security Act and the Medicare Act affects all of our payroll checks. Those two combined into one law called the Federal Insurance Contribution Act, or FICA for short. There's a good chance that you may see a FICA deduction on your payroll check. If not, check line items for Social Security and Medicare. Let's take a look at these payroll laws. The Fair Labor Standards Act of 1938 is sometimes also referred to as the Wage and Hour Law. There are specific limitations on who it applies to, but it basically says that employees who work beyond 40 hours in a work week are entitled to time and a half, or 1.5 times the regular rate of pay for the extra hours. Some states, like California, have even more restrictive laws. This will help us in computing gross pay. Social Security laws date back to 1935. The Social Security tax was designed to provide benefits for employees and their families, either as part of a retirement or for benefits of dependents of a deceased worker, or the benefits for a worker and the dependents if the worker becomes disabled. The 6.2% rate hasn't changed in many, many years, but the maximum amount of earnings subject to the percentage changes every year. As of 2019, the maximum amount of wages subject to the tax was $132,900. This is what we consider a matching tax because both the employer and the employee pay equal amounts. Be very careful when you are calculating Social Security taxes to watch out for that maximum. The Medicare tax is another matching tax that is paid by both the employees and the employers equally. That means both pay 1.45% of total earnings. Notice that there is no maximum on the Medicare tax. So if you make $1 million, you pay taxes into the Medicare system on that same amount. In addition, the rate hasn't changed in many years. The purpose of the Medicare tax was to pay for medical expenses in a retiree's older years. Another law that affects all of us today was the Federal Income Tax Amendment to the Constitution. It was established by the 16th Amendment. I believe the year was 1913. And basically what it says is that all of us will pay into a pay-as-you-go income tax. What that means is, back in biblical times, the tax collectors came by your house one time at the end of the year and expected you to fork over a whole lot of money. You can imagine what it would be like if someone came knocking at your door and said, by the way, you owe $4,000, $5,000, $6,000. Most of us wouldn't have it. So the 16th Amendment established a pay-as-you-go system where each pay period we would have a little bit deducted from our paycheck, and then we would square up at the end of the year. This tax is based on earnings during the pay period, the frequency of how often you get paid, your marital status, and the number of withholding allowances you claim on your W-4 form. We'll talk more about this tax later, but I wanted to introduce it to you while we were talking about payroll laws. By the way, that federal income tax is computed based on a sliding schedule known as Circular E. In addition to federal income taxes, many states and localities have their own income tax. The state of California has a very hefty one. The rules are generally almost identical to the federal income tax withholdings, but different schedules are used to compute the amounts. So let's get busy on the calculations. In this example, Sam makes $10 per hour and works 51 hours. He is subject to the Fair Labor Standards Act, which says that employers must pay overtime at the rate of time and a half for anything worked over 40 hours. In this case, he would get paid 40 regular hours at his pay rate of $10 an hour, and the additional hours, the difference between 51 and 40, would be 11 overtime hours at time and a half. $10 an hour times 1.5 is how we derived the $15. When added together, this amount of gross pay totals $565. This is the beginning of the payroll calculations, because in most cases his gross pay will be used to compute the remaining deductions. Based on Sam's gross pay of $565, let's calculate his mandatory payroll deductions. Sam is married, claims 2 withholding allowances on his W-4, and is paid weekly. He has not yet met the maximum threshold for Social Security. His Social Security tax would be computed as $565 in gross pay times 6.2%, or 0.062, equates to a Social Security tax of $35.03. Next, Medicare tax, which has no maximum, is always based on the full amount of gross pay. In this case, $565 times 1.45%, or 0.0145, equates to $8.19. Lastly, his federal income tax is based on a sliding schedule. We'll take a look at the Circular E used to determine how much his federal income tax is in the next slide. As you will recall, the 16th Amendment to the Constitution established a pay-as-you-go federal income tax. In this case, to get Sam's federal income tax withholding, on the left-hand side, you'll see the list of wages. Up across the top, you'll see the number of withholding allowances claimed on the W-4 form. Take your finger and move across the column of the wages to where your finger intersects the number of withholding allowances at the top. In this case, Sam's withholding on this paycheck will be equivalent to $30. Many of us have voluntary deductions, or things that we choose to pay into. These aren't mandatory like some of the other taxes we learned about, but oftentimes employers will sponsor other benefits expecting employees to bear some of the cost. In this case, let's assume that his medical deduction is $50 for this payroll period, and let's assume his union dues are $15 for the payroll period. Let's see what Sam's paycheck looks like now. Here's a summary of the payroll computations. We started by using the Fair Labor Standards Act to compute Sam's gross pay. We then went through and computed 3 mandatory deductions: Social Security at 6.2% of his gross, Medicare at 1.45% of his gross, federal income tax that we used a circular E or a sliding scale to find, and then 2 voluntary deductions, things that Sam wanted to be withheld but that aren't necessarily required. Those 2 items were given at medical insurance for $50 and union dues at $15. When we added up all those deductions, they totaled up to $138.22. That means that Sam's net pay, sometimes called take-home pay, was $426.78. Let's take a look at how this would be recorded in the General Journal. There are 2 journal entries to record the payroll. One records the actual expense, and the second one records the payment. On this screen, you see the journal entry to record the payroll. The wages expense was debited for the gross pay. Each individual deduction that is withheld from the employee's paycheck is credited to a payable account. So the Social Security tax withheld was credited to Social Security payable. The Medicare tax withheld was credited to Medicare payable. The federal income tax withheld was credited to federal income tax payable. On the voluntary deductions, we had a medical insurance payable for $50 and a union dues payable for $15. When you take the difference between the debits and the credits, or another way of saying it is when you take the difference between the wages expense and all of the deductions, you wind up with the net pay. In this case, the net pay totaled $426.78, and that rounded out our journal entry as the net pay was credited to wages payable. This is the journal entry to record the payroll. It intimidates some students because of its length, but if you take it step by step, it's really not that bad. The journal entry to pay the payroll once the payroll checks are released is a debit to wages payable to get the liabilities off the books and a credit to cash. Notice that this is the amount of the net pay. Workers' compensation insurance really isn't a tax, but it's more of an insurance policy, and it's handled like a prepaid. When the amount is first paid, the company debits prepaid workers' comp insurance and credits either cash or accounts payable. It's based on earnings for the upcoming year. This means it's an estimate. Different rates are given based on how safe or not the job is. The premium paid at the start of the year is then compared to the actual wages cost when the auditor comes in, and an adjustment is made based on the actual wages. Make sure you review this topic in your textbook and be ready for a small test question. There's lots of new terms and definitions in this chapter. take the time to go over the glossary of terms and make sure that you are well prepared for the exam on payroll. This is Professor Johnson signing out.